Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Well, Canada recorded a budget deficit of more than $18 billion between April and October of 2025. This represents a 26.6% increase from the same period last year. Program expenses rose, reflecting an increase in major transfers to persons and provinces. Revenue also increased owing to customs import duties due to countermeasures to U.S. tariffs and corporate and personal income tax revenue. Holiday retail spending in Canada rose 4.4% annually, according to Visa's Retail Spend Monitor. In-store shopping dominated 88% of the total sales. Online sales rose to 12%. Clothing and accessory sales grew 10%, leading all retail segments. Visa says AI is beginning to shape how consumers discover products and compare prices. The monitor analyzed retail sales activity between November 1st and December 21st. Copper hit an all-time high above $12,000 US a ton. Severe mine outages and trade dislocations linked to the U.S. administration's tariffs put the crucial industrial metal on course for its biggest annual gain since 2009. The impact on global trade flows has been so extreme that prices have rallied even though underlying usage has deteriorated rapidly in China, which consumes about half of the world's copper. And how are the markets doing right now? It's been a little bit of a yo-yo day for the TSX. After closing at a record high yesterday, it's hovering right around it again, up ever so slightly, but still above that 32,000 mark. South of the border, they're all sitting near record territory, not quite there. And they're also in the green right now for the day. The Santa Claus rally looks like it's continuing. You can see S&P 500 up by 0.3, Dow by 0.2 roughly, and the NASDAQ up by 0.34%. Well, Canada can claim a lot of great thinkers in paving the way for the future, including the foundations of AI. We were joined earlier by Mark Daly, co-chair of the Council of Ontario University's Working Group on AI and a professor of computer science at Western University.
Canada is already a world leader. We punch above our weight in AI. We are the home of some of the scientists who created the deep learning revolution through which we're now living. And there's an opportunity for us to lean further into that and develop capacity right here in the engineering space.
So we have Cohere, a major player, and you say it's been successful. But you say we lack what you call a truly public option, a foundation model built by and for Canadians. What is that in AI terms, a foundation model?
So foundation models are the big models that are typically generalists. Like when you log into ChatGPT or Google's Gemini, you can sort of ask it any question and it can come up with an answer. And those foundation models require huge scale engineering, not quite like the Apollo project, but think on that order. And it's not something you can do one university alone or one small entity alone, but working together, you could create a training environment where you learn how to build these foundation models, and then that becomes part of the sovereign AI skill set of Canadians.
So I think your argument is we don't necessarily need to build a huge one in Canada along the lines of OpenAI or Google's Gemini, but we do need to develop the skills here.
Exactly right. This isn't about competing directly with OpenAI. That's not something for the public sector to do. What we're interested in is creating the capacity for a new generation of Canadian startups to have young, smart people who have those sort of intangible skills that you only get by building these things.
But ultimately, the technology will need the giant engines, won't it? And they'd be in the hands of Google or ChatGPT.
I think there's another path. And if you look at what came out of the G7 digital ministers meeting, you can see Canada making agreements building partnerships where there's a world in which like-minded nations co-create the infrastructure so that we can each run sovereign AI systems. And I think Canada is really well positioned to walk that path.
Switzerland has launched a project along these lines. Germany has, and Singapore.
That's right. So this isn't something radical that I'm proposing. There are good models we can build on, like-minded nations we can partner with to co-develop this, and it's within the realm of the possible for us.
I mean, the question here is, how much are we going to be subject to U.S. tech dominance? And it is a question of sovereignty.
I think when you hear our Prime Minister and our AI Minister talk about AI sovereignty, this is exactly what they mean. They don't mean that Canada has to build everything alone in a shell. It means that we need to have the capacity to decide intelligently what we're going to buy from whom and what we need to build ourselves.
So what change in government policy do we need to see right now?
I think we're moving in exactly the right direction. This interest in building clubs of like-minded nations to create together, to share expertise, and to grow systems that we can share with each other.
Mark, I have to ask you, as a computer expert, how exciting have the past few years been with the rise of these large language models?
So neural computation is what I study. And where we're at right now is somewhere that 5 years ago, I desperately hoped we'd get here before I died. I wasn't even optimistic before I retired. And here we are now. To me, as an expert in the field, it feels like we're 2 decades ahead of schedule. So I wake up every morning and think, wow.
I got to admit, I'm a bit like that. When I ask an AI engine a question, I'm pretty stunned. What will be the next thing? I mean, what about hazards? Are you worried about uncontrolled growth of AI or the thing even becoming in some way self-aware? I know we're getting into philosophy there.
Yeah, so I'm less worried than some of my colleagues, but I absolutely acknowledge their concerns. But I think this is something that we can manage as humans. We have to have these discussions. The UN is in the process of appointing a new expert advisory panel. It's tough because these discussions have to happen at the international level, and there's no international enforcement mechanism. So all of the world's nations have to be incentivized to work together. But we've done this before, we can do this again, and we're taking it seriously in the way that it deserves. So I am optimistic, but that doesn't mean that I sort of want to say, okay, everything's going to be fine. It is important for us to continue to advocate for our governments to take this seriously.
And he was speaking with Mark Daly, the co-chair of the Council of Ontario University's Working Group on AI. He's also a professor of computer science at the University of Western Ontario. Coming up after the break, BNN Bloomberg's Lindsay Biscaya hosts a roundtable conversation with Andy Bell and Bloomberg's Derek DeClue, looking back on the year of commodities.
Hi there, I'm Lindsay Biscaya, joined by BNN Bloomberg's Andy Bell and Derek DeClue, executive editor of Bloomberg News Canada, for a little conversation about year-enders, what's been making the news this year. And of course, you can't really end 2025 without talking about commodities. We saw some interesting runs this year when it comes to gold, silver, even copper. But oil prices were a big topic of conversation as well. Derek, we started out the year thinking maybe oil prices would be higher. But it's interesting to see what's happened with oil prices throughout the year and the drop we've seen.
That's right. I mean, I would have at the start of the year thought that, with Trump going into the U.S., very sort of pro-growth economic policy, tax cuts and all that sort of thing, that you might see a bump. But we're ending the year with prices being very, very soft. And it's really a supply story. Russia just shipped the most oil in a week as they have any week since the invasion of Ukraine. They are, and people may not like that, but, India is there to buy it. China is there to buy it at a large discount. And then you have other suppliers sort of, coming on stream. I mean, Guyana is filling up an oil tanker almost every day. They didn't used to produce oil at all. So you have you have all these sort of factors. Canada, too, is adding to the production mix with the Trans Mountain Pipeline, being able now to ship oil to Asia. So there's a lot of supply out there, and that's the reason that we're seeing what we're seeing currently, which is prices, West Texas Intermediate kind of around where it was 11 years ago. It's hard to believe. That's
what's interesting is more countries seem to want to get into the game, like Canada included, in terms of producing more oil and selling it. But there's also talk about a supply glut in 2026.
Yeah, and OPEC apparently, and the Saudis essentially just changing their game plan, deciding, nope, we can't afford to lose market share in the long run, and going for broke, opening the spigots and increasing production despite this weak oil price. It really indicates that they are concerned about losing their grip on the oil market in the decades to come, and they're willing to forego so much revenue in terms of a higher oil price. I mean, to be pumping away with oil well below $60, it fell below $60 late in 2025, it indicates that the world is pretty well supplied.
On the flip side, gold saw quite the run this year. Andy, I'll start with you. Gold, silver as well. I mean, what do you make of what you saw this year?
Disturbing, really. Because it's great for the gold bugs, and they've been proved right. But when you see people buying something that is not money, that does not pay interest, and that is a hassle to hold in the physical form, it does. I think it's a little disturbing in the sense that you hear people are losing confidence in G7 wealthy nations because of rising debt loads. Even gold is meant to be an inflation hedge. Inflation has, to a large extent, been conquered. It hasn't been completely eliminated. Of course, it got back to 2%. But I think it's a little worrying when you see gold surging like that. It speaks to fear.
Well, and I think it also speaks to concern about what's to come in inflation, right? One of the features of this year was the president of the U.S. really trying to jawbone the Fed into cutting rates very fast, and the Fed has cut rates at a more measured pace. But if the idea is that they're going to run interest rates lower than they should be in the U.S., run the economy hotter than it should be, you're going to see inflation, and I think the gold price is a pretty big indication that that's a very real worry out there.
Interesting. People should remember that gold can be dead money for a long time. It peaked in 2011, and it didn't get back to that level until the end of 2019. So that was about 8 years that gold did not go up. Now, we're at an all-time record peak for gold right now. In the past, gold has been fallow for a long period, but of course, nobody knows what's coming.
And you're seeing, you mentioned people buying gold. Central banks have also been buying up the gold. Not Canada, though.
No, Canada decades ago essentially got rid of its gold reserves, just decided that wasn't the strategy. I mean, in retrospect, doesn't look like a good move. But of course, central banks, in a way, they're not trying to speculate on the value of assets. They're trying to diversify risk.
When we're talking about commodities, I mean, we saw some really big acquisitions this year, particularly in Canadian companies, right? A lot of mining companies. Anglo Tech was a big one that was just almost finalized. The federal government signed off on it. A big company promising to keep their headquarters in Vancouver. Like, what does this mean for the mining landscape in Canada? Is that important that you have a headquarters in Vancouver, do you think?
It's another miner lost. In a way, I thought the government might even have been tempted to block it, but it would have been tricky. The Keevil family, the controlling family, were willing to see it sold out. And we did get this SOP thrown to Canada. The head office will be in Vancouver. But in the past, in foreign takeovers, we've seen guarantees given. And once the corporate lawyers get a look at it, they can be a little fleeting, the actual commitment to these promises. And they didn't move the domicile, the actual location of the merged company or the primary stock listing. And the government apparently had indicated, certainly reportedly, we want you to do that. But they backed down. They couldn't get Anglo American to agree to that.
So what the government did get in the end was some greater assurance around the number of jobs that will be around the head office. But as we have seen in the past, these guarantees are good up until the point where hard times hit. Right. And then inevitably there is some flexibility, and sometimes there's flexibility that has to be given. The thing about this one, though, is that the Keevils, which you mentioned, have controlled the company for ages, they were about to give up control in a couple of years. They were going to lose their multiple voting shares, and so Teck, at that point, would be vulnerable to a takeover anyway. So part of the government's calculation is, who do we want to take it over? And Anglo being sort of a relatively smaller company compared to BHP or Rio is probably, for Canada, a better buyer.
Okay, and then we also saw, that Cenovus Meg acquisition, some more consolidation when it comes to the oil sands in Canada. A concern at all, or do you think this is just something also that maybe needed to happen?
Well, the ownership of the oil sands over the years has gone into fewer and fewer hands. They're solid companies, but, when you have a quasi-monopoly like that, it's very tough on suppliers to the industry. If I'm supplying services, I'm getting fewer and fewer possible buyers of my services. Obviously, foreign companies have pulled back from the oil sands, and we've seen buyers, notably Canadian Natural Resources, stepping up. But it's turning into a smaller and smaller group of companies.
That's right. Really, you can count on one hand now the number of really big players, and this one just takes Cenovus a little bit bigger. You've got Cenovus, Suncor, CNRL, as you say, and the foreign guys. They've all exited. They've all decided, or not all of them, but almost all of them have decided to take their money elsewhere and try other things. I thought this was a really interesting. Cenovus and Meg were really interesting, like corporate drama and the personalities behind it. Yeah. The Meg people did not necessarily want to sell. They kind of got forced into it by Adam Waterous, the billionaire who's behind Strathcona Resources, pushed the company into play, and then it was sort of a months-long tug of war that sort of inevitably ended up with the heavyweight, Cenovus in this case, winning, but at some cost.
Meg was arguably in play ever since Husky, quite a few years ago, made a bid, and then that fell apart, and Husky itself ended up being swallowed. So Meg was going to be taken over probably sooner rather than later.
Okay. Yeah.
And if there was a logical buyer, for Meg, sure. It definitely was Cenovus. Yes. They're going to be able to get a lot of cost out of it and make it a more efficient operation.
Okay, we'll end the conversation there. Thanks to both of you. Appreciate that.
Thanks.
And stay with us. We'll be right back.
Well, we have seen and covered much of the impact of U.S. tariffs and the negotiations. For Kusma, our next guest, will take us through a recap of that and what to possibly expect as we head into 2026. We are joined now by Jacques Shore, Government Affairs and Trade Specialist at Gowling WLG. And Jacques, thank you very much for joining us.
Good to be with you, Roger. Thank you.
What can you sum up this year in a word?
That's hard because I think that basically students of the economics, political science, government affairs, trade will be studying this year for a long time. It's been a remarkable year, but I'm going to give it a go. First of all, when I look at it, the year essentially started off effectively with a seismic shift as a result of the election in the United States with Donald Trump coming in. And to a great extent, that affected the world order and really dominated, I think, our Canadian political landscape as well. Remarkable, as we saw, amazing rise of Mark Carney as our prime minister in the face of that, because I think Canadians recognize there could be a looming crisis ahead. Mm-hmm. So there's been a lot of work on since then and really changing, I think, the dynamics of how we look at the world and how we basically look at ourselves. I'm actually quite pleased in the way we've addressed it. Let's remember that we started off essentially with a throne speech once the new Liberal government came in. And it basically said the true north is indeed strong and free. So we started off with something recognizing we had to look to ourselves, we had to strengthen ourselves. And then we came up with the One Economy Act that would actually create major projects that we would need to deal with. And obviously, we got caught up in a very significant, how can I say, set of changes with respect to our trading partner, imposing on us very significant trade tariffs, steel, aluminum, lumber. You just look at some of those key areas, autos, what that's done. It's upended us to a great extent. But at the same time, remarkably, we are looking to addressing those things. We're not looking to diminishing, I think, the trade relationship we have with the United States. I hope it grows. I expect it should grow. We've got CUSMA negotiations coming up. But we've been diversifying our trade in the way in which we have been reaching out to other corners of the world, to Europe, to the Indo-Pacific. These are countries that I think we can look to because we can rely on them if that's what we're going to do to grow it. We have a target in the next 10 years to increasing our trade to $600 billion. But that's in 10 years. So there's a fair bit of work that has to be done until then. So that is to a great extent on that trade side. And essentially, I can also say, as we look to the United States right now, look, there are other elements that we could look to, even just recently, the U.S. national security strategy that came out, which gives us some pause. I mean, I think, and I've shared with others, let's remember that we're very active in NORAD. Let's remember that we are partners in many ways. But this is also another, how can I say, glimpse at the way in which the Americans are looking at the world, and gives a sense how we have to look at them. I still say they are our allies, they are our friends, and we just have to look to the last 40 years, which has been incredible in terms of our trade relationship. But we're careful. And I think that we have to understand that there are risks out there. There is uncertainty. There is unpredictability to some extent. But we're going about it, I think, in a very sensible way at this moment.
Now, it's been, I guess, 8 months since all of this really started to unfold. Reaching out for trade, are we starting to see results for developing trade outside of North America, outside of the U.S. as our partner?
So my sense is yes, while we haven't necessarily concluded, how can I say, arrangements completely as we would want them to, we know that there is a focus on that. But I'm going to also shift to the fact that we understand that our relationship with Europe is extremely important. Just recently, we concluded an agreement with them that touches on basically security matters. And I think that's important. On the trade side, the meetings, just think about the number of visits actually our prime minister has taken to different parts of the world to actually deal with trade. Someone just the other day, mentioned that our prime minister is more of a merchant. I mean, is certainly a banker, but very much a merchant in terms of wanting to open up those doors. And so I think that is happening. There's much, much more activity, certainly as we're looking at Germany, as we're looking at Italy, as we're looking at countries that in the past, Switzerland, that have really now taken a step. I was just in Switzerland a short while ago, meeting with potential investors there. And our trade commissioners are actively engaged. We've just made a significant commitment in our recent budget for enhanced funding for those efforts abroad. So this is moving, I think, in the right direction. I basically would say, isn't moving fast enough. And I think that there is an element there that we have to really seriously look at how we've addressed things in the past. We have issues that we've got to address. We've got regulatory burden. We've got red tape, unnecessary red tape in a number of instances that don't make us all that, how can I say, palatable, perhaps, as a country to invest in because of some of those difficulties. But I believe we are basically looking at them. Can we deal with them quickly enough? I think that that's a challenge. We still have our internal trade barriers. I know that was something that the Prime Minister and the Premiers basically made a commitment to actually address fully. They are. But again, it's one of those things that I think we have to press our politicians to make it happen. If we really talk about a one Canada economy, then it really means that the provinces, along with our federal government, have to align, and they have to recognize that the challenges we see today are not like we've seen in decades. So they have to come together on that.
Okay, we'll have to wrap it up there, Jacques. But thank you very much, as always, for joining us. Have a wonderful holidays, and we'll see you in 2026.
My pleasure. Thank you so much, Roger, and wishing you the best as well.
That was Jacques Shore, Government Affairs and Trade Specialist at Gowling WLG. Up next, Canada may be looking to court offshore investment in the housing market. We'll talk to our next guest on what that means for the future of housing right after the break. Canada's monthly GDP fell 0.3% in October, according to Stats Canada. The manufacturing sector off by 1.5%, mostly due to a drop in machinery production. Wood product manufacturing recorded its largest decline since April 2020, reflecting the impact of U.S. tariffs on Canadian lumber service. And disruptions were as well. There were some service disruptions due to strikes, reduced activity in the public sector, alcohol retailers, and transportation and warehousing. Shares of Strathcona, take a look at that, off by more than 24% right now. The energy company being one of the worst performers on the TSX. The Calgary-based company completed its previously announced special distribution of $10 per share. The firm also disposed of its marketable securities portfolio. According to data compiled by Bloomberg, Strathcona owned 14.2% of MEG Energy and competed with Cenovus to buy the oil sands producer outright. Shares of GDI Integrated are soaring after the facilities services company announced it will be taken private. It's up 24% right now. The Quebec-based company entered an agreement with Birch Hill Equity and guest Jean-Claude Migras. The $36.6 per share is the cash offer. It represents a 25% premium to GDI's closing price on December 22nd. GDI's current management team is expected to continue on. The deal will likely close in the first quarter of 2026, pending shareholder approval. And looking at the markets, the TSX, again, flirting with 32,000. It's over it again into record territory on the green side right now. And the U.S. market's also looking like they're going to start a Santa Claus rally here. You can see them all well into the green right now. The S&P 500 up by almost 0.4%, the Dow 0.3%, and the Nasdaq by 0.44%. Well, Canada's housing minister thinks 2027 could be the year to expand Canada's housing market. He cites success in Australia's housing model in attracting foreign buyers, but would it change real estate law for Canada? Here to talk about what that means for the market and changing real estate laws for home buyers is Joel Fox, COO of OwnRight. Joel, thank you very much for joining us.
Thanks very much for having me.
It's an odd situation. It feels like just more than a year ago, but it just seems like just recently we were talking about too much foreign ownership, and now there's a talk that maybe we want more foreign ownership.
Well, it's amazing what happens when you have a few years of high interest rates and poor performance in the market. You start to see folks wanting to put cash or put fire back into the market. And we just had a month of pretty weak results from Korea in terms of November home sales. And so it's naturally going to spark up the conversation about changing the restrictions on foreign homeowners and home purchasers. So not surprising to see it come in. And, looking forward, I think we'll probably see some other thoughts coming from government and other folks in that realm to think about how we could stoke the market a little bit and get it moving.
Where is foreign ownership right now? What are the regs on it?
Well, there's a restriction on non-residents coming in and purchasing property. And, I'm not the perfect person to speak on that, but really what it means is we're not getting people coming in from outside of Canada purchasing property here. And that was a restriction that was put in place a little while back to support domestic ownership. We saw housing prices soar, particularly in Toronto and Vancouver, and people started to wonder how we could get an end to that. And so the foreign home buyer restriction was one of the mechanisms that was put in place to help curb that growth. And then since then, we've seen interest rates go up, and we have seen the market activity decline, and we are seeing housing prices decline. So again, not surprising to hear that as we look at 2026, the real estate market, not looking overly rosy. 2027, of course, they're going to consider some opportunities to pour fire on the market.
Would that not, the whole idea wasn't to kind of get it under control to offer opportunities for people to actually buy a house. Would this not heat the market up and move it further away from Canadians looking to buy?
That's the ultimate debate. And it's not a simple answer on, whether or not if you open it up to foreign home buyers, if it's going to improve the market and if that's actually beneficial. Because there's still affordability issues. And while we have seen home prices overall come down over the last little while, it doesn't mean that home ownership is affordable for the everyday Canadian. And so I think folks that are looking to get into the market and still feel that it's not affordable for them are going to be frustrated to hear the talk of opening up that foreign home ownership here. However, folks that are in new builds might be excited by that because a lot of activity was driven.
Is that where a lot of the foreign ownership goes to? Is the new builds? I look at it as an investment. Absolutely,
and what we've seen over the last year, especially the new build market, particularly the condo market, has really suffered. So again, we want to see investment in Canada. We want to see home ownership increase amongst our people here. But we also want to see investment returns. And so that's where foreign home ownership and investors becomes an option that people think about. But again, you're going to have some people on the argument that feel very strongly that it's the way to go. And then you're going to have your everyday Canadian that's still thinking about how do they get in the market, that's going to be frustrated by a conversation like this.
When there was all the talk of foreign ownership, was it as big an impact as people thought it was?
It's a good question. I think the answer is no. I think the non-resident ownership is actually quite low. And so there's a lot of arguments stating that, really the foreign home ownership and investment wasn't what was driving up prices. And, around the time of that conversation and this ban being put in place, we had extremely low interest rates. So people, both inside of Canada and outside of Canada were investing because cash was cheap. And real estate was absolutely booming. And, there was a bit of FOMO and people were looking to get into the market. Yeah. So whether you're talking foreign investors or domestic investors, I think a lot of that growth in pricing and, what people would say has created this affordability problem came more so from investors, not necessarily foreign investors. However, there's multiple sides to that argument.
And it's a difficult balance because you want to bring houses bring them down to an affordable level, but at the same time, there are people who bought houses, and that's the last thing they want to hear is that the house they paid 1.2 for is now worth $1.
Exactly. And when you talk about the everyday Canadian, what you're really struggling, or the people that you need to think about in terms of who this impacts, is those that are looking to enter market, and then those that are looking to exit the market. Those that are, buying and selling are going to be less fussed about the exact pricing right now because, they sell and they get to buy back in a similar market. But you have a lot of people that are sitting on the sidelines, both from a buying perspective and a selling perspective, that have been waiting for things to get back to normal. And I think there was a lot of expectation going into 2025 that things were going to start to bounce back. Yeah. And, your sellers were going to see some increased prices that they would be able to cash out on, or your buyers would be able to enter the market at, more reasonable interest rates. Everything that's happened south of the border has driven a lot of uncertainty into the market. And that resulted in a pretty weak housing market this year. So again, looking ahead to next year, realizing that, the uncertainty that's driven from south of the border isn't going anywhere, there's naturally going to be a conversation about how we can stoke the market and get things moving.
And if you are getting into the market at this point, whether you have to, whether you want to, whether you don't want to, but you're going to be involved in it, or renewing mortgages, what are you looking at? What should you be looking at? Fixed, variable?
It really comes down to personal comfort and how comfortable you are with risk. So those that I think actually uncertainty is driving a lot of what's happening in the market right now. So the recent interest rate hold, I think we might actually see that drive some confidence into people and maybe take them off the sidelines. And then if you're a buyer, you're still going to look ahead, look at the broader economic landscape and be a little bit uncertain about what's going to happen. And I think that's going to drive people to fixed. But you're always going to have your risk takers that are going to believe or place their bets on the interest rates going down. And, kudos to those folks. But I do think, the everyday Canadian right now is just left a bit uncertain. And if they're going to be coaxed off the sidelines, I think you're likely going to see those people going fixed because at least that brings some semblance of certainty to them.
Okay, we're going to have to wrap it up there. But Joel, thank you very much for joining us. We appreciate it.
Thanks very much. Appreciate it.
All the best on the holiday season.
Thank you.
And that was Joel Fox, COO of OwnRight. Coming up, hot picks in banks, including one that's currently sitting on about US $16 billion in excess capital when we come back. Time now for Hot Picks, and we were joined earlier by Mike Clare, Senior VP, Senior Portfolio Manager at Brompton Funds, to discuss his top picks in banks. We kick things off with Citigroup as his top pick, a stock he says is likely to benefit from several trends in the banking sector, including expense efficiencies driven by artificial intelligence.
Citi's been our number one pick in the banking sector for the better part of the last year, and we still think that they have pretty strong momentum into next year as well, capitalizing on the three key trends we see in the space. Number one being regulatory relief, We're also bullish on the capital market cycle, which is about 30% of their business, and of course, expense management. On the regulatory side, Citi sits on about $16 billion of excess capital currently, but we should see in the first half of next year, we should see some pretty tangible things coming out of the U.S. administration on the regulatory side for banks. Number one being reform of the GSIB surcharge, which affects the capital levels for the largest banks in the U.S., as well as we should see finalization of the Basel III endgame rule that we expect to come out next year as well. For Citi, that means they could double their excess capital levels, and we expect them to buy back a lot of stock. They bought back about 2.5% of their stock in the third quarter alone. We could see them buy upwards of 10% of their stock through the end of next year, and notably because they traded at a discount to other banks out there, trading around book value now. They can do that on an accretive basis for their shareholders.
It looks like there's been quite a spike in Citi lately, Mike. It looks like investors are buying into the thesis here.
Yeah, I think that the market's starting to catch on. They had, they're looking at, they've been an underperformer on the return side. They've had a target of 10 to 11% return on tangible common equity for 2026. It looks like they're going to hit that. They announced an investor day for May 2026 where they should come out with new targets. So we think they should, be able to do better than expected, raise guidance, even with consensus numbers out there having them growing earnings per share by over 30% in 2026 alone. So we think there's potentially upside there.
So the return on Citi over 5 years, about 135%, not bad, beating the financial index. But Morgan Stanley's been a charm to own. People have trebled their money in the past 5 years, including dividends. But you see more upside.
Yeah, we still see upside across the capital market space. Really, I mean, Morgan Stanley in particular has built a very strong equities business, and they've done very well on the trading side. But we're just actually starting to see an uptick in investment banking revenues, which is really their bread and butter. Investment banking, capital markets overall, up until the last couple of quarters, has really gone through quite a bit of a downturn with M&A activity running something like 30 to 40% below long-term averages, ECM activity running more like 50% below long-term averages. That's just started to tick higher. Of course, there's lots of talk out there about potentially some big IPOs for next year, the likes of OpenAI, Perplexity, potentially some others, right? So Morgan Stanley has a very strong technology franchise in particular, very strong equities business, and we expect them to be in the game on a number of those deals. Just to give you a sense of some of the numbers, in their most recent quarter, Q3, investment banking revenues were up something like 44% year over year. ECM alone up 80% year over year. And we think that momentum really continues into 2026, and there's potentially more upside to consensus as they continue to perform well.
And then finally, Citizens Financial has caught your eye. What's the attraction here with what do they do?
Yeah, so Citizens Financial is one of the regional banks. We do like not just the large cap banks. We like regional banks or some of the higher quality regional banks heading into 2026. So this is your typical retail and commercial bank operating in New England, the Mid-Atlantic, and Midwest regions. But what we really like about it is there's pretty strong visibility in terms of returns improvement into the next couple of years. So they're currently operating around 11% return on tangible equity. We think there's pretty strong visibility to improving that number to 15% over the next 18 to 24 months, just given some lower yielding assets roll off and they can reinvest in higher yielding assets given that rates have moved higher over the past couple of years. They've also done a really good job. They've been focusing on building out a private bank, which targets high net worth investors. And that's starting to have a big impact on results as well, impacting earnings by about 7% this year. That could grow to 10% next year and potentially doubles longer term. And then on the capital side, Citizens, relative to its regional peers, has one of the highest capital requirements. These smaller banks only participate in the stress test every 2 years, so they didn't participate in 2025. So when they do participate next year in 26, we expect to see a decline in that number similar to some of their peers. And ultimately, they'll have excess capital, which they can either deploy into the business to grow the private bank or to put into buybacks. And again, this is a company that's growing earnings, something like 30% plus in 2026 and potentially another 20% plus in 2027. Trades at 12 times earnings, which is just too cheap given the fundamentals. So it's a stock we really like here.
Andy was speaking to Mike Clare, Senior VP, Senior Portfolio Manager at Brompton Funds. Still ahead, today's market movers with Bloomberg's Matthew Griffin. Well, for some movers south of the border, we're joined now by Bloomberg Equities reporter Matthew Griffin. Matthew, thanks as always for joining us.
Thanks for having me.
Okay, Firefly Aerospace, it was soaring, and then I guess it got too close to the sun, and now it's crashing back down to Earth a little bit. I went Icarus there.
Roger,
I don't know. It's Firefly. It's the end of the day for me.
Roger, I was just thinking before this segment about how I was going to talk about a space stock without using any puns, so I'm glad you've opened up the playing field a bit for me. You could say that space stocks, including Firefly Aerospace, are, coming down to earth a little bit. Over today's trading session after a really strong 3-day rally. Firefly is a space launch company. This is a stock that really hasn't worked for investors since the company went public in August. The shares are down about 40% since then, but they had a rally over the 3 sessions before today. Space stocks were broadly stronger after U.S. President Donald Trump signed an executive order favoring the sector. There's a bunch of goals in there, but the big one is the aim to return astronauts to the moon through the Artemis space program and actually establish a permanent presence on the moon. Firefly rallied about 50% across Thursday, Friday, and Monday. But again, some of the steam's gone out of that rally today. Shares down more than 7%. Seems like this is not enough to revive investor enthusiasm in a lasting way for this stock. And you see other space names like Intuitive Machines, like Rocket Lab, also selling off today. Sounds like a little bit back to reality, back to earth, but then maybe who knows where it'll go from here. Any indicators? Is it going to keep dropping, or is this just kind of we've sobered up on what we bought there, let's just figure it out? Hard to say for any one stock. I would say that the administration has seemed to make space a real priority. Both the space exploration and the military applications side. Another thing listed in the executive order is the Golden Dome missile defense program. That's been a priority of the administration all year. Defense stocks have really rallied in part on that program. Other priorities, including space. A lot of this we really have yet to see whether it translates into money being spent and action being taken, but it seems like it might be an enduring priority. I think that's something that investors are really going to be watching. All right, let's go the other way and talk about beauty, makeup, things like that. You and I wear it. Coty. Coty? How would you pronounce that? Coty? It sounds like it should be French. I say Coty, but to be honest, I am less than completely sure. I like the French version. Okay, it's been downgraded, though. You're right. It probably is French. So Coty, yes, they got a downgrade to hold equivalent rating at Evercore. This comes a day after the company said that their CEO, Sue Nagy, is going to depart at the beginning of next year. Former Procter & Gamble executive Marcus Strobel will replace her. This is a move that comes as the company's really struggled. Shares down more than 50% this year. You had some trouble in the consumer segment, but even so, Evercore said that Nagy was critical to the investment thesis for this stock. They see it as undervalued, but they don't see clear catalysts, at least not with timing. And so they're moving to the sidelines. Seems like Matthew, investors are too. I got to cut you short there. I didn't realize we had so little time. I completely missed a cue. But thank you, as always. Have a great holiday. Bloomberg's Matthew Griffin. That wraps up this edition of Trading Day. I'm Roger Peterson. Thanks for joining us. I'm done for a few days. Enjoy your holidays.